Good morning from our global headquarters in New York City. I'm Matt Miller in for Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda for the day. Geopolitical tensions flare up. U.S. intelligence reportedly suggesting Israel could be gearing up for a possible strike on Iran. And a criticism from Nvidia CEO Jensen Huang blasts U.S. chip curbs on China, calling it a failure to hold the nation back from progress. And we continue our coverage of the Qatar Economic Forum with Ashmore Group CEO Mark Coombs. And in this hour, we're going to speak with Abigail Watt of UBS, as well as Lori Calvasina of RBC Capital Markets. We will also go live to the Qatar Economic Forum, as I said, for an interview with the CEO of the Ashmore Group, Mark Coombs. But back to our top story. Oil prices are surging following a CNN report that the U.S. has new intelligence suggesting Israel is preparing for a potential strike on Iranian nuclear facilities. For more, we're joined by Bloomberg's Golnar Motavelli, who leads our coverage of Iran. Golnar, thanks so much for joining us. What's the likelihood of this kind of attack, and would it be sanctioned by the U.S.?
I think it's difficult to say whether this attack is going to be likely or not, because we've heard this kind of thing from Israel before. I think the difference here, and I think one of the key things, is that this report that was published by CNN was coming from U.S. intelligence sources, not from, as it were, or as we understand, from Israeli sources. So if that's the case, it suggests an intention from the US administration to maybe distance itself from the intentions of the Israeli state militarily towards Iran, and to maybe signal to Iran, because obviously we have these nuclear talks, these very important nuclear talks between Iran and the US going on in the background, maybe a signal to Tehran to say, if this is the case, if this is happening, this is not us, we're warning you. So there are different interpretations out there, but definitely the key thing I think to focus on is what's going on in the background geopolitically, which is these nuclear talks between Iran and the US.
Yeah, it seems like that was somewhat of a priority for President Trump last week when he was in the Middle East, saying he doesn't want to leave Iran essentially in nuclear dust, and that he has high hopes for the country if they come to an agreement. Is it likely that Israel would act without U.S. Sanctioning the attack?
It's very difficult to say. I think the consensus, maybe, if you speak to analysts and maybe officials who are watching this, is probably not, given the extent to which it feels that Benjamin Netanyahu is isolated on the international stage because of the war in Gaza at the moment. And as you just mentioned, Trump's trip in the Middle East, that was seen as a huge success from the eyes of the Trump administration, and indeed the Gulf Arab countries that have drawn closer to him. And in that trip, he didn't go to Israel, as we saw, and there was a sense that Israel and Netanyahu were not involved in that at all. So I think on balance, I think it's unlikely that we would see the United States at this time sanctioning that kind of strike. And maybe that's the way to interpret this report altogether, that this is actually the US signaling that Israel may want to do this. And by doing so, it's giving Tehran a chance to respond in kind.
We are seeing Brent crude rise just 1.4% right now to $66.26 a barrel. How much oil, remind us how much oil Iran is able to deliver right now, even under the sanctions that that the U.S. has imposed upon it?
I think some of the estimates are around, I think the last time that we looked at this using other third-party watchers was something around 1 million barrels a day. But that's probably going to reduce back down, because obviously we've had more sanctions from the Trump administration, and we've had this strong pledge from Trump to drive Iran's oil exports, as he said, back down to zero, which is what he tried to do in his first term. He never completely achieved that, because Iran has kind of developed ways of working around sanctions for years. But the key difference we've seen this time with the Trump administration is that he's gone directly after those Chinese small refiners, those teapot private refineries in China. And that is going to make a big difference and could be key to the extent to which Iran's oil exports are going to come down in the months ahead.
All right, Golnar, thanks very much for your coverage on this. Golnar Motavelli covering Iran for us out of Bloomberg News there in the London office. Now, Sell America is back with 30-year Treasury yields again rising above 5%. And the Kuwait Investment Authority managing director, though, saying that being underweight the U.S. is something you do at your own risk. Joining us now is Abigail Watt, U.S. economist at UBS. And Abigail, I guess, you know, the big, bold call behind Sell America is that the dollar no longer reigns, I guess, as supreme as it did. Not that we expect it to fall out of its position as world reserve currency, but that the premium it has commanded will be reduced. Do you agree with that premise?
Look, I think there's many cross currents ongoing at the minute in terms of some of the moves that we've seen across US assets, not just in the dollar. I think obviously you've had the kind of policy uncertainty, both around trade policy, and now I think coming to the fore is kind of policy uncertainty on the fiscal side as well. So I think with these cross currents, I think you're seeing a lot of movement in US assets generally. I think the question around the potential for some of the uncertainty to go away and how much that's driving some of these shifts, I think that's one of the things that will be important going forward. And then as well, obviously, on the fiscal policy side, we continue to see that kind of moving through Congress. I think the question is where that ultimately ends up. And I think in terms of the timing of the bill, the kind of tax cuts versus kind of tax hikes and when spending cuts might come into play, I think that's going to be the really key thing, rather than just the focus on the overall deficit widening that could come from the bill.
What kind of deficit widening are you expecting from Republicans if they can get this legislation through in any kind of shape like the one that's been reported?
Yeah, so the CBO actually released some scoring yesterday of the full bill in its totality, and that would imply around a 2.3 trillion deficit widening relative to current law. I think the key thing to note here is that there's a couple of different dynamics happening. So you're having the extension of the 2017 tax cuts that were set to expire at the end of this year. Now, that extension we would see as something that keeps the tax policy unchanged, and we wouldn't necessarily see that as a tax cut that would be stimulative for the economy. So when we're looking at the numbers here, we're trying to think through kind of how much of this is kind of new stimulus, how much of this is new additional tax cuts on top of the extension of the TCJA. And in addition to that, how much of this is kind of spending cuts? You know, what are we seeing in terms of kind of cutbacks on spending? Now, our sense is that the kind of pattern in the bill, it looks like you could see some of those tax cuts coming sooner. You know, a number of the provisions such as kind of no tax on tips and the kind of increase in the standard deduction for seniors, some of these things that featured heavily through the president's campaign, those are set to kind of sunset by fiscal year 2028 in the current form of the bill. But that front loads some of the potential for kind of fiscal policy to boost growth. Our sense is, though, that overall, when we look at the dynamics in the bill, we think that you'll see kind of a couple of percentage points potentially added to growth from fiscal policy in 26 and 27. But when we think about the kind of relative boost that we think we saw in kind of 23 and 24 of around, a percentage point, these numbers look relatively small in terms of the potential impulse for growth in the US.
How, Republicans, Abigail, often say this TCJA must be extended. If not, it would be a huge tax hike on Americans, trying to make the 2017 tax cuts that were supposed to be temporary permanent. How important is that to the U.S. economy? What kind of hit would we take to growth if it weren't extended?
Yeah, so look, I mean, if we look at the scoring of the TCJA extension, so that it looks to be about 4.2 trillion over the 10-year budget window in terms of the extent of kind of revenues lost to the extension of the TCJA. So, I mean, that is a large fiscal cliff that the US would have faced at the end of this year, if potentially that wasn't extended. That is something that is being extended within the provisions that are making their way through Congress in the current bill at the minute. And unlike some of the tax cuts that have been made in addition to that, which are set to sunset at the end of 2028, that has been put in terms of a kind of permanent a permanent kind of provision in the bill. So those 2017 tax cuts have been included on a permanent basis in the current form of the bill. I think the question is, with the sunsetting of some of the other actions, the question would be whether they are kind of ultimately extended in 2028. I think there's a separation here between the kind of near-term fiscal impulse that you could see from the act and then the kind of longer-term deficit implications in terms of debt sustainability.
So what kind of growth are you forecasting now, Abigail, for the U.S. economy, and how many cuts is the Fed going to give us to help get to your forecast?
Yeah, so I think when we look at the kind of balance between tariff policies and fiscal policy, we continue to think that tariff policies will be a headwind to GDP growth this year. So we're expecting the economy to grow below trend at around 0.9% this year. That's a clear step down from the 2.5% rate that it grew at in 2024. We do think that there's some scope for a kind of pickup in growth next year. We think to around kind of 1.5% in terms of 2026 growth. Now, part of that is some fiscal impulse, but also, we are expecting the FOMC to ease policy. We think that they'll cut rates back to around neutral and remove excess restrictiveness this year. So we're expecting the next cut from the Fed in September, and we think that they could deliver around 100 basis points of easing this year. Now, that's predicated on our sense that we think that the unemployment rate will also move higher. We're expecting that the labour market will weaken off the back of the weakening in growth. And if you didn't necessarily see that weakening in the labour market, then I think that could curtail the extent of easing that we do see from the FOMC this year.
All right, Abigail, thanks very much. Abigail Watt there, U.S. economist at UBS. Really appreciate your analysis. We would like to note, by the way, that the Bloomberg terminal is currently experiencing some technical issues which are being resolved as quickly as possible. We'll keep you updated with the latest market information as we can. Now let's get to the other top stories trending on the terminal this morning. UK inflation jumped more than forecast to 3.5%. That's the highest rate in over a year. The jump prompted investors to reduce bets on interest rate cuts from the Bank of England. The pound is now rising to its strongest level since February of 2022. Julius Baer disclosed it is taking a loan loss charge of $156 million related to its private debt business and selected positions in its mortgage operation. The CEO said it's not expected to uncover additional risks that could lead to further losses. The review is its credit portfolio is still ongoing. After the U.S. has removed the de minimis exemption, other countries are considering similar moves at a meeting of G7 finance chiefs in Banff, Alberta next month. The Canadian finance minister spoke at a news conference about those discussions.
We started that discussion, but certainly the low-value shipments have created a number of things that we want to discuss amongst ourselves and see how we can progress that discussions, because it's not only about the revenues, but it's really about, the customs and making sure that we protect our respective jurisdiction, that these packages are not used to smuggle things in different jurisdictions.
So the translation there, you may see more tariffs coming from other countries on cheaper Chinese goods. Coming up, Nvidia CEO Jensen Huang is urging the U.S. to ease restrictions on AI chip sales to China so he can have a bigger slice of the pie. We'll take a closer look next. This is Bloomberg. Nvidia CEO Jensen Huang blasting U.S. restrictions on AI chip sales to China. He told reporters yesterday that the export controls have failed to stop the Chinese from developing their own advanced AI technologies. They've done so at least in part with Huawei. The U.S. restrictions have forced Chinese companies to buy chips from their own designers and caused the government to invest heavily in their own supply chain. And Nvidia and other American chip makers may lose out on getting a bigger slice of the pie. Joining us with more is Bloomberg's Charlie Wells. Charlie, it looks like Jensen Huang is concerned that we're basically going to lose market share here in the U.S. if we allow the Chinese to continue progress.
Yeah, Matt, I mean, those are some fighting words there. And there were some of the fiercest critiques that he has made of this export control policy to date. And it's really striking. We're seeing this sort of ratcheting up of two sort of diametrically opposed ideas here, right? So on one hand, you get the follow through from this Jensen Huang idea, which is that we should remove barriers. We should allow American tech, American chips, Nvidia chips, as you emphasize there, to proliferate around the world, right? And that would, in a sense, at least according to this strategy, prevent, say, Chinese competitors from coming up. This would require, or at least enable, a lot of developers around the world, be they in China, be they in the United States, be they in, say, Saudi Arabia, to develop on that U.S. tech stack. Now, this stands in opposition to that more protectionist policy that we hear from some corners of D.C., where the idea is just to bring about these export controls, to not allow the likes of China to use American-made chips. But of course, this Wong point is that that just enables competitors.
So I guess Jensen Huang was with Trump in the Middle East. They've managed to sell a lot of chips to some of those countries with the president's help. Does he expect President Trump to then help him sell more of those chips through to China?
You know, it's kind of hard to read the kind of tea leaves within the administration because you do have some divergence here. So Wong's views align with David Sachs, the AI czar, who really has been kind of pushing that American tech stack. And I think if you look at some of these deals, some of these announcements coming out of the Middle East, it really speaks to this idea that, yes, you know, lowering barriers to trade and a lot of this AI technology, people are comfortable if it's with, you know, allies or at least countries that are not China, but that there is this real strong opposition to China. And if we just look to date to see what Wang has been able to do, he has not really been able to turn the tide on views of those export controls to China. So that is something that maybe there could be a shifting tone on. Maybe there's this view that a lot of these Gulf deals kind of help pay the way for China, but at least that has not happened yet.
Yeah, I mean, I guess, partially a concern and potentially an opportunity, depending on who you are, is the idea that he can sell large blocks of chips to these Gulf states that they then sell on to China.
That's right. And I think, you know, these, you know, harsh comments also just kind of speak to a shifting narrative that we're hearing on AI out of this Computex conference this week, which is so different from what was happening a year ago, right? Where there was this exuberance, this excitement about AI. The possibilities seemed endless. But now we're getting kind of defensive, very fierce, you know, points being made. I think an attempt to try to make sure that this American control dominates. And I think there's this idea that, you know, have people forgotten about DeepSeek? Have people forgotten, given that we've seen a lot of recovery in markets over the past few months, forgotten the enormous threat that a lot of these Chinese competitors showed earlier in this year?
All right, Charlie, thanks very much. Bloomberg's Charlie Wells reporting live from London on the Nvidia situation. Important to keep up with one of the heaviest weights on the S&P, one of the biggest companies in the world. Coming up, a look at what else is making headlines around the world. This is Bloomberg. This is The Brief. This is Bloomberg Brief. I'm Matt Miller in New York. Time now for our front page news, a look at what's making headlines around the world. First up on the Wall Street Journal, Google takes aim at AI firms challenging its search dominance. Google is overhauling its iconic search engine to compete with a wave of AI chatbots. At its developers conference yesterday, Google said it's rolling out a tab for an AI mode for users in the U.S. Next up on the New York Times, the Justice Department has opened a criminal investigation of former governor and New York City mayoral candidate Andrew Cuomo. This comes after Republicans accused him of lying to Congress about decisions he made during the pandemic. A spokesman for the Justice Department and a spokesman for the FBI both declined to comment. And on the Financial Times, the IMF's Geeta Gopinath said U.S. fiscal deficits are too large and need to be reduced over time. She also warned that the U.S. is still grappling with a very elevated trade policy uncertainty, even after recent tariff easing. The alert comes as U.S. legislators are discussing a sweeping tax cut package that will widen the deficit even further. Coming up, we speak with Lori Calvasina of RBC Capital Markets as geopolitical tensions keep the market cautious. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Matt Miller. Let's set your agenda. Geopolitical tensions flare up. U.S. intelligence reportedly suggesting Israel could be gearing up for a possible strike on Iranian nuclear facilities. And a criticism from Nvidia. The CEO, Jensen Huang, blasting U.S. chip curbs on China, calling it a failure to hold the country back from its own progress. And we continue our coverage of the Qatar Economic Forum with the CEO of the Ashmore Group, Mark Coombs, in this program. Now, Morgan Stanley has raised its call on U.S. stocks and treasuries. The S&P 500 index will reach 6,500 by the second quarter of 2026. Now, that sounds pretty high, but it is actually below consensus. Joining us now is Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Lori, thanks so much for joining us this early on set. To me, it sounds high because of the shock that we went through after April 2nd, the big drawdown. I know we've bounced back up almost 20% now from the lows, but can we go another 600 points from here?
So look, I mean, I think it's all about time. And frankly, I think it's also about the macro. And I think we've got a lot of uncertainty in that macro backdrop right now. But I will give you a sense of the numbers. I haven't changed my target for this year. We're still at 55.50, and we have not done one for 2026. I just want to make that clear. But the other day, I did update my earnings model and my valuation model. My earnings model, I only do for 2025. I've got it 258. Next year, I'm kind of like looking at the consensus numbers, which are 299, and then also kind of haircutting that by around 9%, which is your typical downward revision from this point in time. So it gets you closer to like 270-ish. I forget the exact number. So if you take all those numbers and then you look at multiples, I updated my valuation model for our economist views of this year and next year, and I'm going to spare you all the details on the math, but when I run through that against those earnings numbers, I get to 57.30 for the end of this year, and next year I can get you up to 68. Now, if that's on the more
for the end of
2026.
Yeah.
Now, if I take and now that 6,800 is if I take the more favorable 299 EPS.
Right.
If I take the haircut one, I get something a bit lower, and I think the range is like 6,200 to 6,800. So, and you could drive a truck through that, right? But it is too early. But I would just say that 6,500 number, right, is kind of smack dab in the middle of that range. So it's not totally crazy.
Right. From an earnings standpoint, I get that you could have that optimistic view.
Yeah.
How do interest rates affect those numbers? Because right now there's, I think, a little bit of a mini freak out going, right? We've got the 20 and the 30 year above 5%, the 10 year at 4.5%. And this Republican Congress aims to broaden out the deficit. They want to increase the debt substantially, and that causes concerns among foreign investors.
So I would say, sort of four ways you can look at it. So let's just take that last point you mentioned, the concerns of foreign investors. That was something people were really focused on, let's call it like 2 months, 6 weeks ago. And it felt like that was dying down. And I think what this Moody's downgrade has done, my rates team would tell you, there's nothing mechanical here, right? They feel like maybe the concerns are overblown a little bit. But at the same time, it's giving the people who were making the Sell America trade on the deficit concerns, it's just bringing that issue right back to the surface. So that's one thing. If you put that aside and look at interest rates more discreetly, there are a couple ways you can think about it. One, our cross-asset model, earnings yield gap analysis. That math gets problematic for the stock market if you hit 5.3% on 10-year Treasury yields. But what we've seen the last few years is the market starts to really get worried and act out on those worries when you start to make that approach to 5%. So that would be sort of your second issue. 4.5 is okay. Getting close to 5, not so okay. The other ways you'd think about it, I would say one.
And that has what effect on earnings?
In terms of the earnings yield gap model, it doesn't impact earnings per se. It's just more perception of what asset class you want to be in.
Okay.
I was actually going to get to the earnings one next, which is just if you think about interest expense and pushing that up, that's where the 10-year yield really matters on sort of my earnings analysis. You bring it up, right? You bring Fed expectations up. You're gonna increase your interest expense, right? And I've had some pretty favorable interest expense baked into my earnings outlook. The last way is just purely thinking about valuation multiples. Push the 10-year Treasury yield up, push the PE multiple on the S&P down. I will tell you, though, inflation matters a little bit more than interest rates for that last calculation. We've done a model, and I know there's going to be someone writing me some hate mail or you some hate email on that, but we actually have modeled this out back to 1962. And while you do care about interest rates, the inflation environment, I think, matters a little bit more in here.
Okay. So this same group at Morgan Stanley, I think Serena Tang is the global head of cross-asset research, and it's her team that has done this. They expect rates to come down on the 10-year to 3.45% by the end of this year because of 2026 Fed rate cuts priced in.
Yeah.
So does your inflation model allow the Fed to continue cutting at this level?
So the RBC House views, that's actually what I baked into our valuation refresh that we put out on Monday. And Blake Gwynn is our rate strategist. He's fantastic, by the way, and he will get up early. But he'd be better at walking through this than me. But he's basically got, I think, 3.8 at the end of the year, and they've got 3 Fed cuts. And they've said the cuts start in September. They do think the Fed call is very tricky. But they do, I think as a house, RBC macro, we're concerned. We're not looking for a recession. We are still looking, for sort of, slightly weaker GDP growth. I think our full year number comes out to 1.2%. Our economist was saying, think of it as like 0.5% to 1% if you're thinking about those quarterly numbers. So we kind of have this idea that, we're not going to have a recession, but we are going to have to pay some economic costs, right? There's some economic damage that's going to be incurred from everything that we just went through and everything that's coming from the tariff. So it's a tricky spot. But we do, as a house, expect those cuts to come back in. And Blake does have, 10-year yields moving up and then 10-year yields moving down again. And that filters through into my earnings model. The interest expense number does end up being favorable. So if we dial down those cuts, if we see interest rates creep up, it is going to be a headwind for my earnings number.
I have Blake's bio page here on my screen. It's got his number and his email, so I'll get him on the show for sure. Bottom line, you're looking at still lower S&P level than here for year-end 2025. I imagine you expect some growth for 2026. What do you tell the average investor out there, retail, who has money every month to invest? Continue to stay invested in U.S. stocks?
It's funny. There's been this whole narrative out there about the retailer has been buying the dip. And I tell you, I watch the EPFR data every week, and I don't see any big surge in flows. So I don't know what people are talking about there. I do know that anecdotally, when I talk to people in the advisor community, some people are buying the dip and other people are not. So, I do think maybe the headlines out there have gotten a little bit ahead of the reality of the data on the ground. But look, I think as stock investors, right, and I do equities. We do kind of 6 to 12 month time horizons on our targets. When we think longer term, we know that these periods of turmoil end up being buying opportunities. We don't know exactly, sort of how quickly you get back to past highs and when you exit the period of chop. And I am increasingly coming around to the view that we're in an extended period of chop, that this is not off to the races. And if you think about, that move that we've had since April, we've really recovered a lot of that loss. And to be clear, in April, our view was that we were going to have a growth scare, that we were not going to price in a recession, which is where you would have gone to like 4,500 on the S&P. We thought the risks there were rising, but we really thought this was going to turn out to be a growth scare with like a 20%-ish type drawdown. And that's basically what we got, 18.9%. We've rallied hard off the bottom. That is typically what you do. But this
also about 18.9%,
yeah,
right?
Yeah, and if you look at again, that valuation modeling for 5730, that's baking in a better view of GDP than what we had pre-Liberation Day. Like it's baking in, or post-Liberation Day rather. It's baking in the idea that maybe we got a little too pessimistic around Liberation Day, and we're, anticipating things being a little bit better, but still not things being back to where they were in January. And I'll tell you, Matt, last week, after the kind of China, U.S. pivot, I got a lot of questions about, well, why aren't you just slapping, the target you had back in January, just put the 6,600 back on? And I said, we're not back there. I was never sort of looking for a disaster here, but the idea that we've just sort of erased everything we've been through just doesn't make sense.
Right. Well, I mean, even if tariffs are taken down, they're still relatively high, 10% baseline, 30% on China. And you could argue also that some economic damage has been done.
Yeah, and I think we see that in the sentiment data. And look, it's so fascinating. If you look back at this reporting season, there's two views of the consumer out there. You look at the credit card companies, you look at the banks, you look at any of these processing companies that take a higher level look at the data, and they're like, oh, the consumer is still fine, they're still spending, the numbers are up year over year, yada, yada, yada. And then you go talk to the consumer companies, and they're like, yeah, they're still spending, but guess what? The high end is trading down. They're going to the discount retailers, right? You're hearing the companies that make snacks saying, people are not snacking as much. I read another company last night that was talking about the pressures on snacking. Smoking is under pressure. I mean, you see all these symbols of cautious consumer behavior underneath the surface. They're not exactly battening down the hatches, but they're getting ready for something, and that something isn't good. And so, the idea that we're just right back where we were in January, where there was all this optimism, that's just not realistic.
All right, Lori, great having you in here. Really appreciate your time this morning. Lori Calvasina is the head of U.S. equity strategy at RBC Capital Markets. Let's get to our other top stories trending on the Bloomberg terminal this morning. UK inflation jumped more than forecast to 3.5%. That's the highest rate for the UK in over a year, and the jump prompted investors to reduce bets on interest rate cuts from the Bank of England. They still expect one, but the pound has risen to its strongest level since February of 2022. Julius Baer disclosed it is taking a loan loss charge of $156 million related to its private debt business and selected positions in its mortgage operations. The CEO of the Swiss private bank said it's not expected to uncover additional risks that could lead to further losses. The review of its credit portfolio, though, is still ongoing. And the U.S. has removed the de minimis exemption to cheap goods out of China. Other countries are considering similar moves at a meeting of G7 finance chiefs in Banff in Canada next month. The Canadian finance minister spoke at a news conference about the discussions.
We started that discussion, but certainly the low-value shipments have created a number of things that we want to discuss amongst ourselves and see how we can progress that discussions, because it's not only about the revenues, but it's really about, the customs and making sure that we protect our respective jurisdiction, that these packages are not used to smuggle things in different jurisdictions.
So other countries could raise tariffs on cheap Chinese goods. Coming up, we head for day 2 to Doha of the Qatar Economic Forum. We speak with the CEO of the Ashmore Group, Mark Coombs. Next, this is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York for Danny Berger. Let's head over to Doha right now, where Bloomberg's Francine Lacroix is live from the Qatar Economic Forum in Doha. Francine?
Matt, good morning. I'm so happy to speak to you here. Look, we're 2 hours ahead from London, so that's many hours ahead of New York, and we're in full swing, and I am delighted to be joined by Mark Coombs. Mark, thank you for joining us. Look, we talk about the markets, we talk about growth. We've had some great panels trying to figure out what happens next. We've seen Sell America. Does that continue?
Yeah, well, perhaps. Thank you very much for having me, first of all, Francine. Delighted to be here. Sell America. I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing. So at the margin, buying America is probably less of a momentum trade than it was for the last 2 or 3 years.
But where do you see that changing? I mean, is there a worry that actually some of the policies that hurt the rest of the world really start hurting also America? And can other countries, including emerging markets that you've been following very closely, benefit?
I think the fear is just coming from looking at the sheer dominance of America in terms of the global indices. I mean, if you look at the ACWI, it's 66% of that, with an economy that's probably 20%. There's just a huge concentration of risk and capital there. What we're seeing is people gradually saying, oh, that was a bit of a reset, what's gone on over the last 3 to 6 months. Maybe America isn't riskless. And in terms of what we do, we invest in emerging markets. And every 5 years, we're reinventing the wheel and saying to people, remember that home country bias in the US can be a dangerous thing. Think of diversifying. So I would say from Asia, from Europe, there's definitely a bit of interest in diversifying. US is still fairly concentrated in the US, and from the institutional clients that we're talking to.
Mark, I mean, we're looking at the numbers. We love crunching numbers at Bloomberg, so I'm sure it's no surprise to you. So we've seen outflows from emerging markets over the last 3 years come to around $200 billion. I mean, does that reverse with some of the policy and volatility that we've seen? Is money being put back into emerging markets?
We're seeing the beginnings of it in certain spaces. So I think like a lot of things in life, people like certainty, and while they're seeing uncertainty from the US and in terms of not sure what's going with inflation and growth, people are probably doing little. Uncertainty, people tend to sit on their hands and stare at the wall and go, oh dear. We're seeing a little bit of interest, certainly in the investment grade bond space and within emerging market equities and things that last for the long term. So the key things are healthcare, education, infrastructure, long dated closed end assets. We're seeing some interest in that, because the larger EM economies are going to see a lot of growth and a much higher growth rate than DM. So that story is continuing. But the marginal investor, I would say, is beginning to say, well, where do I go now? Well, wait a minute, is AI just a US story, or is it a Chinese story too? And the Chinese market was so heavily oversold. So I'd say in the bond space, investment grade, we've seen institutional investors, certainly from Asia and Europe, already beginning to diversify and looking at EM. In the equity space, recently there's been a bit of a kick that way.
But are there specific emerging markets that you'd want to be invested in right now? Again, I mean, this is structural. It could also be linked to supply chains and how close or not you are to China that you get slammed.
Yeah, and whether your Chinese goods get routed through you or not. Yeah, so and if people spot it or not and want to make it enough of an issue. Yeah, there are markets we like. I mean, it depends on different things for different assets. I mean, obviously, the larger economies that are strategically important, we think will benefit from a whole series of flows. Strategic, reshoring, nearshoring, natural growth in their own economies. So the bigger ones that can fuel their own growth, we like a lot.
But have you definitely seen flows change this year or since Liberation Day?
A little bit. It's only quite recent.
What's a little bit? Like,
well, because institutions take more than a month to make their minds up. But in terms of retail space, yes, we've seen a little bit of interest. Certainly in the equity space, we've seen a little bit of pickup in investing in EM equity, particularly because I think a lot of people are saying, well, hang on, China was so cheap. And if AI is not just a US story, and seems like there may be an AI story in China, we're seeing a little bit of interest in the equities from retail. Retail you tend to see first.
And you see that, staying, the fact that actually people tend to like equities over fixed income in some of these emerging markets?
Different strokes for different folks. So the rapid trader, the retail investor tends to go straight into equity. Some of the US, for example, is primarily an equity market. When they come back, they'll probably come back to equity first over fixed income. Elsewhere, I mean, the Europeans, certainly the big insurers, the really big pension funds, they like to have a big fixed income allocation. So it's different strokes for different folks.
Your best conviction, actually, for emerging markets,
for an equity return or a bond return or an alternative return?
Both.
My best single country or... Wow, actually putting me on the spot.
What am I giving you? 2 million. You want 2 million? And like the highest where'd you put the 2 million right now?
2 billion or 2 million?
2 million.
I like you less than if it was 2 billion. Come on, lady, give me 2 billion. I think it depends what you're trying to do. I mean, I think best near-term opportunity is probably things that have been sold the heaviest, that are fundamentally quite large economies. We think there is an opportunity actually in China around that tech space. We think there's obviously an opportunity in India. India has this terrible habit of getting overbought by retail and getting a bit volatile, but we like India, we always have. We think there's scale there. And we think Southeast Asia, there's stuff going on. We like Indonesia, we like things around that space. Within Latin America, I think Mexico is a lot structurally going on in Mexico that's interesting.
Right. I mean, you mentioned alternatives. I mean, what do you do with private credit at the moment, or even private equity in some of the emerging markets?
So private equity, we tend to try and follow three main themes. The things that we think the larger economies really need to develop and help them going forward: healthcare, education, and infrastructure. And what we're trying to do there is structure long-dated money to go with what they're trying to do, which is create growth, but also they're normally trying to build their own domestic pension system, and those systems need long-dated assets. So we like to do that both in the debt space and the equity space. So some of the most interesting things we're doing is 25-year development capital for road systems, airports, power. So we like all of that. We're less, I mean, there is a consumer story, there is obviously a retail story, but that's less our thing. We're more into the sort of the boring bits that go for a really long time.
Okay, what looks expensive at the moment?
The US.
In emerging markets.
The US, just kidding. Everyone, in the end, everything's an emerging market. The only difference is emerging markets, the price is normally set for it. What looks expensive?
You know what? I've heard of stories in trading floors where emerging market, actually, traders that used to deal in emerging market in the 90s were very good at trading equities in the US over the last couple of weeks because it's a real advantage knowing how to trade it.
Distress is distress. So, yeah, you certainly need to be thinking, especially when you get political issues. So you're asking me what's the most expensive in the end?
Yeah. Is there something that it's just not the right time to, that you're either selling off? Give me two enemies.
I won't make any enemies. People understand. I think things occasionally rally a bit quickly. Sometimes you get a very sharp rally. There was a bit of a relief rally around the Romanian election. So that was a bit of a knee-jerk relief rally, and that settled a bit. I think that's probably fine. They have a lot of things to sort out. Long term, we think as long as they do sort it out, it'll be fine. Otherwise, EM is actually relatively cheap, especially against the US. I mean, come on.
I see one enemy. No, I'm kidding. Thank you so much.
Hopefully not.
For joining us, Mark
Pleasure.
Coombs.
Thank you for your time.
A fun interview there with the Ashmore Group Chief Executive Officer. Matt, with that, I'm going to send it back to you in New York, and we'll have plenty more from Qatar, Doha.
That was a lot of fun. I appreciate it. Francine Lacroix there in Doha, the anchor of Bloomberg's The Pulse, speaking with Ashmore Group CEO Mark Coombs. He's the boss of our buddy Gus. Coming up, we're going to get you set up for your trading day with earnings and a bond auction at a time when the Treasury market is being watched very closely. This is Bloomberg. This is The Brief. This is Bloomberg Brief. I'm Matt Miller in New York for Danny Berger. Let's get a look at what's ahead today. More retail earnings with Target, Lowe's, and TJ Maxx reporting before the bell. Plus, President Trump hosts South African President Ramaphosa at 11:30 a.m. Eastern. And tune in for an exclusive interview with the Speaker of the House, Mike Johnson. He'll be on with Bloomberg surveillance co-anchor Anne-Marie Hordern. That's at 9:25 a.m. New York time. That's it for Bloomberg Brief. Surveillance is up ahead. This is Bloomberg.